Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates, 10-year note yields. Just kind of taking a day to watch and wait. We have a big announcement coming tomorrow, and new Fed Chair Powell making his first semi-annual testimony to Congress. So we've seen bond yields just kind of hover around 285. Recall we went out last Friday and the previous 3 Fridays at around 285, 287. So it's been kind of a market that is kind of waiting for that next catalyst, that next it moment. And certainly a Fed chair speaking for the first time in front of Congress could be that moment. Obviously, the market is waiting to get some kind of sense as to where new Fed Chairman Powell will stand on things like growth, the yield curve, market volatility, supply, fiscal spending, all that. And I'm sure he will get grilled by our friends in the House. And that is really what the market is waiting for. I don't see this as a period of rest for the market, looking to maybe jump 20 basis points higher or lower. It's waiting to absorb what the Fed chairman says and how the Treasury curve will react to his speech. And volatility is telling you the same thing. Volatility remains elevated. It is off the highs. It's off those highs we saw in about 2 weeks ago in February, when things were all going haywire in the equity markets. But we're still elevated, and we're still above those levels we saw basically throughout all of 2017. So the market is weary. I'm not saying it's a fear trade yet, but it's on yellow alert, we'll call it, until we get over this next hump of information, whether it just be the Fed chairman's speech to Tuesday and Thursday to Congress, or you can look a little further. You've got employment the following week. You've got FOMC coming in March and all that. So there are some key data points to notice. And if you look at the curve, the yield curve, something that has really troubled the Fed, the 2s-10s curve has been trading in near all-time lows. We did see a modest steepening of about 30 basis points during that equity flutter, during that period when we saw bond yields rally and we saw the equity markets decline. But that has really retraced about 50%. So we really can't say that the yield curve is steepening. It's really trending back towards that flattening bias. Now, of course, that could all change after the Fed chairman speaks. It could also change if we start to see something change in the supply or fiscal decisions made out of Washington. So there's a lot of things that could change. But right now, the market is reverting to status quo. That is hovering to slightly lower yields, volatility hovering. Yes, it is elevated, but it's not going up anymore, and the curve trending back towards that flatter status. Those are things I think that we don't want to see when the Fed's trying to raise rates. We're talking about GDP going to 4%, and we're talking about inflation rising to 2.5%. So right now, the market has a lot of eyes watching this Fed chair as he comes and sits in front of the Congress this week. And will he have the answers? I don't know if he'll have all the answers this week. But what I do know is that the market will get a chance to meet him. And that's something that we've been eagerly awaiting ever since he put his hand on the Bible in early February and said, yes, I will be the next Fed chair. So right now, the bond market in waiting mode, waiting for Fed Chair Powell to give his testimony to Congress. This is Todd Colvin coming to you from the floor of the CME Group.